My name is Jake, welcome to the channel, and today's video we're going to do a Review My Pie video where I review subscriber portfolios. This is the 49th video of this series, so the next one is going to be 50. That's going to be really cool. I'm excited for that. So for those of you that have been following the channel, I do this about every 3 weeks or so, and as I mentioned these last couple of weeks, my wife and I and our little boy Lucas, we are in the process of moving up to Utah. So we've spent the last couple of years in Austin, Texas. We're going to be living part of the year in Austin, part of the year in Utah, and we're kind of making that move right now up to Utah. So you may be asking, well, why Utah? I actually grew up, I was born and raised in Utah, so that's where I grew up. And so going back home, excited about that. And really just excited to get out of this heat here in Austin. It's been like 100 degrees every single day that we've been here. So I do these videos about every 3 weeks or so. So the main topics on the channel that I like to talk about, I like talking about dividend growth investing. I like talking about the FIRE movement, financial independence to retire early. And I do the Review My Pie series. So those are the main topics that I talk about here on the channel. So in today's Review My Pie, we're going to answer a subscriber question from a subscriber who's 47 years old. And the first portfolio is going to be from a 31-year-old here in the US. The second, a 24-year-old from the UK. And then the third, a 50-year-old from the United States. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links will be in the description. And as always, everybody, I'm not a financial advisor. Don't take this as financial advice. This is just merely for your entertainment. One of the great things about the Review My Pie series is you get to see how other people are viewing the topic of dividend investing. Personal finance is personal. It's personal to every single individual. There are some bits and pieces where you'll see where somebody's similar to you or maybe not so similar, and maybe you'll pick up some new ideas or look at things from a new perspective, a new light. But really, the Review My Pie series is to help give you ideas and inspiration so that you can go and invest and build generational wealth for you and your family. Now, like with anything, if you were to do anything without practice or without understanding the basics of how things work, you're really going to struggle. So the Review My Pie series is really my hope is to kind of get a little bit of that foundation for you, help you with your financial literacy, understand that investing is really not intimidating. It's not hard if you take the time to learn. But if you do dive into something and you jump head first, not knowing what you're doing, it could look a little like this.
Blow the grass. Blow the grass. Blow the grass.
It was at this moment that he knew. He f***ed up.
Oh my gosh. All right, let's take a look at the first question here. The first question is from Bobby, who writes, "Hi Jake, I'm letting you know how grateful I am for YouTube content. After 2 weeks, I'm probably about 20 videos in. So it looks like you're a fairly new subscriber, but you've been binging the channel. That's awesome, man. That's cool. Like yourself, my journey over the past year has taken me from wanting to collect rental properties to desiring a real passive income through high-yielding dividend portfolio. When I found dividend growth investing, I said, yes, this is it. Additionally, as a former educator, I appreciate your teaching methodology and authenticity. Keep up the excellent work." Well, Bobby, thank you so much, man. I appreciate it. What you're referencing here, if you are maybe new to the channel, year before the pandemic, my wife and I, we invested pretty heavy in terms of our portfolio value of rental properties. We sold all of our rentals I think, when did we sell the last one? We sold the last one right as interest rates were going up. So we got out of real estate. We may get back in, but yes, what Bobby is referencing here is we sold our rental properties and we're transitioning that money into our portfolio to really focus on real passive income, i.e. dividends. So you continue writing here, "I would love your opinion as my wife and I have just recently got to the place where we can prepare for retirement. Here's my softball toss to you, or a blanket canvas for you." So I'm 47 years old, have very little debt, have 5,000 in a Roth, maxed out with my company. So your Roth, I'm assuming that's a Roth 401k if it's with your company. You would like to retire at 60 years old in 12 years if possible. In addition to my company's max Roth, in January 2023, we'll have $5K a month, $60K annually to put towards our dividend growth portfolio. That's amazing. So, I think I know what you would recommend. We would respect your informal recommendations. Respectfully, Bobby. Well, Bobby, this is really great. So a couple of things here. So first off, the most important thing here, when you're 47 years old and you're here in the United States, now you're not saying Roth IRA or Roth 401k, but because it's your company, I'm just going to assume that's your 401k, right? So you're 47 years old. The very, very first thing that I would recommend, the most important thing, right, is understanding in which account type you should be investing your money. Okay, because you know that you're going to plan on retiring after the age of 59 and a half, it makes complete sense in almost every case. I don't know your particular situation, but very vanilla, very generic for everyone out there in a similar situation where you pretty much know you're going to retire after the age of 59 and a half, to max out your tax advantage accounts. So maxing out your 401k, maxing out your Roth IRA, maxing out your HSA, all of those tax advantage accounts, really that should be your first thing, your first point of focus. And then if you have money left over, only then would you go and invest into a taxable account. Okay, so the order of operations here, you want to make sure that you're optimizing your tax advantaged account. And the best advice that I can give you is go and make a list of every single account you have, your Roth IRA, your 401k, your HSA, your wife's HSA, your Roth, like all of your different accounts, and look at this holistically. Because you're going to have so many different accounts, you want to look at this as an entire portfolio, not one individual portfolio uniquely, but how do all of these accounts jointly work towards your ultimate goal. And that's why I'd write down every single account that you have, write down how much money you have in there, and write down your goal. Write down your goal for each account and how each account contributes to your overall target, your overall goal in retirement. Okay, I'll give you a brief example. Your 401k, let's say your 401k, you put the majority in, a total US stock market ETF like VTI. Okay, that's what you focus on there. And your wife's 401k, you put in, maybe you have a little bit more real estate, right? Or a little bit more of a dividend focus, right? But each account is going to have its own strategy. All right. And then the next thing that you want to make sure that you're focusing on is you have 12 years. You don't want to mess this up. You want to make sure that you're focusing on investments that are going to yield the highest total return. That is the capital appreciation plus a dividend. Now, the beautiful thing is, because you're going to retire after the age of 59 and a half, and if these are in a tax advantage account like a Roth IRA, you could invest in a balanced approach of growth and dividend growth. Right? And so, for example, you could have one account. Remember how we talked about all these different accounts? You could have one account that's focused just primarily on growth, like VGT, for example. That's my favorite growth ETF, VGT. And then you could fund money in there. And then once you reach retirement, you could sell out of that, pay zero capital gains because it's in a tax advantage account. And then you could repurpose that money for something else. Like, for example, you could buy SCHD, you could buy VYM, you could buy JEPI, you could buy some higher yielding asset that fits your lifestyle. So it gives you a lot of options. So that's the way that I would approach this. I wouldn't just look at this from a single lens. Look at this from a holistic approach, how each account is going to serve your goals. Understand growth rates, what you're going to hold in each individual account. And here's my challenge for you and your wife. After you put this together, talk about it as a group, as a family, right? Talk about it. And if one of you doesn't understand what the goal here is or what you're doing, then it's too complicated. Okay. So what I encourage you to do, whether you put this together with your wife or you put it together for your wife and then you go and you present it to her and say, hey, honey, this is what I'm thinking about doing. If she doesn't understand it, it's too complicated. Okay, so very, very important that you make sure that she's on board. She understands what you're doing. She's the beneficiary, all that fun stuff. But yeah, Bobby, that's really just generally what I would say. The most important thing for you is getting the account type right, understanding growth rates, and having a clear and concise goal across all of your accounts that they're funding. They're working towards one unified goal for you and your wife and your family. So hope that helps. Appreciate the question. All right, the first portfolio here is from Ethan. He writes, "Hey Jake, thank you for taking the time to review my pie. This is intended to be a very small part of my overall portfolio. I currently have 110K equity in rental property, 100K in my primary residence, and 48K in a mostly mutual fund ETF, Fidelity brokerage, and 800 in the attached account, and 11K in my 401K, plus some other stuff. Everything in my portfolios is equities, no bonds. I'm 31 years old in Nashville, Tennessee, and have roughly a net worth of 270K. That is awesome. Okay, so I intend on this being 5K account mostly for fun. I just want to make sure you don't think it's dumb before continuing on for a bit. I have 100 individual holdings, all except Tesla pay a dividend, all blue chip companies, most of which are dividend aristocrats, kings. My thinking behind it is, opposed to getting an ETF, which would pay quarterly, is that by having more frequent dividends, which will be reinvested weekly with my automatic contributions, is that it will compound just a little faster. I think it's a good idea and will accelerate the growth ever so slightly while holding the same thing as Noble or a similar ETF. Noble is the Dividend Aristocrat ETF, okay? But I want to make sure I'm not overlooking something. I don't expect you to look at all my holdings or anything, mainly just letting me know what you think of this strategy. Either way, most of the money will not be in this strategy. I'm a longtime viewer and love your channel, Ethan. Ethan, appreciate it, man. Thank you so much. I think I actually recognize the name right away. So you comment on my videos, I think, every single week. So I appreciate the support, and shout out to Nashville. Okay, so I guess I'm curious to see what we're going to look here. It's always fun when I get an email and then in the email is like a disclaimer, like this is not my, like I'm always excited to see what's to come when there's a disclaimer in the email explaining it. So, or warning me of, okay, something wild is going to happen. I think you're off to a really great start. You're 31 years old. You have a net worth of 270K. You have your primary residence, so you have a home. Are you investing into a 401k? Do you have a you do have a 401k. So you got your 401k. You're approaching this from different angles. You have your retirement accounts. Hopefully you have your Roth account, and you're not just looking at this from one angle. Okay. All right, Ethan, I just saw another email that you have a 5 to 10 year time horizon and you are single. Okay, so, but I guess what I'm going to look at here is more so the overall strategy and less about like the individual companies, right? So I'm sure you have a lot of great companies in here, a lot of dividend aristocrats, dividend kings, there's a lot of high quality companies in here. There's not a lot of like EV or, trendy, well, I guess Tesla. There's not a lot of trendy stocks in here, right? So can you go wrong with this? Probably not. Is it necessary? Probably not. Is it going to make a big difference in the grand scheme of things? Probably not. Now, to your point where you said you might be able to compound a little bit, I actually played around with this a few years ago where when you use compound calculators and you can change the frequency from month or year or quarter, the difference in the compound rate from a monthly contribution or a quarterly is so minimal that it really doesn't even, in my opinion, it's not even worth the air it takes to talk about it to do it. It really doesn't make a lot of sense. It's so minimal that you won't even notice it in 20 years. We're talking maybe a couple of percent over years and decades and decades, right? So I wouldn't get too, personally, I wouldn't get too caught up on, it's like, what it's like? It's like penny pinching. It's like my mom in the early 90s, where she'd bring her coupon book with all the coupons and she'd go to the store and she'd make us wait in line because the cashier had to get all of the coupons, and I get really nasty looks at all the people behind us, like those judgmental looks of people like, how dare you, and that's kind of what this is like, where you're trying to coupon this. Is that a saying? Coupon it? Maybe I'll make it a thing. It's a saying. It's a saying now. Okay, it's a saying. You're couponing it, and I don't really think it's really going to move the needle in terms of whether you and your future potential family are going to be financially independent or not. It might help you for your OCD because it's like, ooh, it's great, that's cool. But in the grand scheme of things, you'd be much better off spending your time and energy seeing how you can maybe go and cut your expenses. If you were to cut your expenses, you're going to move the needle a lot more than making, 1/3% over a 7-year time period in a portfolio like this. So yes, it's cool. It can kind of maybe work. 4 years ago when I first started using M1 Finance, I would have been like, yeah, man, this is so cool. But now I'm older, fatter, and wiser, hopefully wiser, definitely fatter, that I wouldn't even consider this anymore. So that's really my 2 cents there. It's not going to move the needle. You're much better off focusing on areas of your life that are going to move the needle, focusing on the basics, cutting your expenses, staying out of consumer debt, and looking for new ways to make more money. That's going to move the needle. But I do acknowledge and like where you said that this is just kind of a fun side thing, right? So I think you're better off sticking to your primary focus. This can maybe be a little bit of a fun side project. I fully endorse that. But as long as you acknowledge that it's nothing more than a side project, I think you're good. So that's really my opinion on this. Hopefully it was helpful. Thank you so much for supporting the channel, and I'll see you in the comments in this video. All right, the next portfolio is from Alistair. Alistair, I play League a lot, and I always think when I see this name, I always think of the cow in League of Legends. The Alistair. Anyways, hi, hope you're doing well. My name is Alistair. I'm 24 years old from the UK and would greatly appreciate having your opinion on my investment portfolio. I've been investing for 3 years. In the first year, I made a large number of bad mistakes, such as GameStop. My first mistake, GameStop. And having over 300 holdings at one point, and I feel that I learned so much through those mistakes. Man, I think this is so great. Isn't it better that you learn these mistakes at 24 than at 54? So kudos to you, man. I think it's amazing. You can't grow without making mistakes. I think it's great. In the second year, I completed a master's degree in economics and researched as much as I could into dividend growth investing. Your channel was very valuable in determining that this was the strategy I wished to mainly pursue. I even wrote my dissertation at the end of the year on dividend growth investing. That's amazing, man. In the past year, I've been working in the financial sector and refining my portfolio. I split the portfolio 60% into ETFs and funds at 40% into growth and dividend growth stocks. So when you say funds, you're probably talking about ETFs and maybe some mutual funds in there. In the UK, we have an account type called ISA that lets us invest with zero capital gains or dividend taxes. Even so, I'm purely focused on total returns with an approximate 15 to 20 year time horizon in mind. I made a PDF showing my portfolio and have included the dividend yield without withholding taxes adjusted and the 3-year dividend CAGR of each stock, as well as a brief description of the European stocks. Wishing you and your family all the best and your continued success on YouTube. Well, Alistair, this is amazing, man. I think this is so cool. First off, being able to write your dissertation on dividend growth investing, I think is cool. I had to write mine on like some promotional marketing shenanigans. I much would have preferred to talk about dividend growth investing. This is so cool. All right, so let's take a look at this document that you prepared here. So you got your funds at 60%, 40 in stocks. So generally when here in the US, when we hear 60-40, we generally think 60 equities, 40 bonds. but you're doing 100% equities, which I think is the right thing to do for most people at your age, right? 24 years old. Portfolio yield of 1% CAGR. The CAGR is pretty low actually. But then again, it's only 3 year. I bet you if this was 5 or 10 years, this would probably be much higher. Okay. Because just with the S&P 500, you're getting a better yield to dividend CAGR ratio. So something to keep an eye on when it comes to that. Okay. When it comes to the funds, so the funds are once again, the funds are 60% of your overall portfolio. So you got 30 in an all world ETF. So this would be like in the US, if you want something similar, that would be the equivalent of like VT. That encompasses the entire world. You get the entire world with one ETF. I tend to like that ETF. It's a very, very vanilla, very generic way of passive index investing. You got Wisdom Tree Dividend Growth ETF in here. Good. You got a few I'm not going to, obviously, because I'm not familiar with the UK market, I'm not going to know all of these, but I'm looking at, some of these, like a lot of these I'm familiar with the counterpart in the US. So it seems like you're looking at quality. You got information technology in here. I'm looking at like sector allocation, semiconductor, you got a thematic ETF in here, which is only about 5%. I think that's good. I personally, as a thematic ETF, I probably wouldn't do more than 5 or 10%. So I actually really, really like this. And I like, because you have VT or the Total World ETF in here, you really, it shields you from making a lot of mistakes. Okay. If you don't have an ETF, like a broad-based ETF, you really are saying that you know better than the market. And most people, 99.9% of people don't know better than the market. And the 0.01% that do usually end up in jail because they know something that the rest of the people don't know. So I think it's good that you're taking this approach. And I think most people would benefit from a similar approach, whether that be in a single account or, I talked about this earlier, where if you have multiple accounts, having a broad-based ETF like a Total World or a Total US Stock Market ETF in a different account. Like for example, in my Roth IRA, 45% of my Roth IRA is in VTI, 45%. So I really like this strategy. You got growth in here. You got Amazon, Alphabet, AMD. So you got 12% in growth. This is 40%. So now this is 60%. Now we're looking at the 40%. So you got some individual companies in here. I mean, you got some really high quality companies. In terms of your portfolio, this is, okay, so what the question that I had is, this is for all of you dividend nerds out there, when you have a portfolio makeup of ETFs and stocks, you want to make sure that you're looking at the total portfolio. So this represents the total portfolio and not just the percentage of the stocks. Do you understand? It's not just the percentage of 40, but rather this is the percentage of 100 of your overall portfolio. That can mix a lot of people up. That can get a little bit confusing. So that's good to see. So you got some growth in here. I like that you don't have it overweighted too heavily. Now this is the percentage of the growth percentage, and this is the percent. Whoa, it's really blue. How do I get this to go away? Okay, so this is the percentage of the overall portfolio. This is the percentage of the growth stocks. I follow you. This is the sector allocation of the individual companies. Now, I want to share a secret with you that I didn't really realize until later on. Okay, so when I first started building my portfolio and constructing it, I tried to get optimal sector allocation. But when I realized that when you follow the core and satellite approach to investing, where the majority of your holdings are in ETFs, the sector allocation is not as important as before. Now, if you don't have any ETFs, then yes, sector allocation is incredibly important. But if you have broad-based ETFs, the sector allocation for your individual holdings is not as important, okay? Because you're getting all of that allocation, that spread allocation through these ETFs. Okay. Now, assuming that it's a broad-based ETF and not like a sector ETF, right? Okay. So your energy. So what stocks you got in here? You got, I'm not going to go through every single one of these. I do love seeing Waste Management in here. Lockheed Martin. Okay, cool. Games Workshop. Okay, some big blue chip names. Okay, cool. All right, some real estate in here. You likely will have to pay a tax, and I'm not 100% sure how it works. Like, for example, in the US, I can invest into companies in the UK and pay zero international tax. However, if as an American, as a US citizen, if I invest into a UK REIT, real estate investment trust, I have to pay international tax. Okay, let me say that one more time. As a US resident, if I invest into a UK business like, I don't know, like Unilever or something like that, I don't pay any taxes on international tax. Now, if I were to go and buy a REIT, I will pay international tax as a US resident. You might want to check and see if it's similar on the reverse as a UK resident if you pay an international tax on US REITs. Okay, so hopefully that didn't go over your head. A lot of the tax fund jargon stuff there. Okay, so these are all your individual stocks. This is the percentage of the portfolio. First thing, I love to see that there's no one position over 5%. I love seeing that. You have some really high quality names in here. So let me do a little brain exercise with you here. And I want you to listen to this, and I want you to think about what's right for you, because I don't know what's right for you. Okay, so let's take a look at Procter & Gamble. So Procter & Gamble is your 35th holding out of 42 of these dividend stocks. Okay, so Procter & Gamble, great company. Okay, so let's imagine for a second that you reach that goal in 20 years. In 20 years, you're like, heck yeah, I reached my goal. I'm retired. I've reached my goal. I don't know where I'm going with this. You reached your goal, and you have, let's say as an example, $1 million portfolio. And let's see, okay, once you've reached your goal, your target for Procter & Gamble is 0.00371. Okay, that is the percentage that you want allocated into Procter & Gamble. That means you will have a whopping $3,710 invested into Procter & Gamble. Now, Procter & Gamble generally has a 2.5% dividend yield. So of this 3,700, you're going to times that by 2.5%. That means you will get on an annual basis $92.75 from Procter & Gamble. Procter & Gamble pays a quarterly dividend divided by 4. Every quarter after you've reached retirement, you will get $23.19 from Procter & Gamble, roughly. Okay, you see where I'm going with this? With $1 million portfolio, you're invested $3,700. That's not really that much, is it? Are you a true shareholder of Procter & Gamble with $3,700? Now, imagine you have a $500,000 portfolio. Cut that in half. So the question that I want to ask you is this what you really want? Do you really want to be invested into, quote unquote, with asterisks, into 42 companies? Do you want to, quote unquote, invest into 42 companies? Now, everyone's in a unique situation. The reason why I'm sharing this with you is I was in your shoes not too long ago where I was going through this brain exercise for myself. And I realized, no, not really. No, I don't want to have anything less than, as an example, $10,000 in any individual company. So if you have $1 million portfolio, 10,000 is what, 1%? Now I'm going to embarrass myself. Let's make sure that that's correct. 1%. Yeah. Okay. So you're the math major, not me. So all of these from 19 to 42, all of these holdings, you will have less than 10,000 invested into these if this is your target. Do you understand that? And so that's why for me, what I decided was like, you know what? I'm not going to have any company less than 1% of my overall portfolio. It's just, what's the point? I'm not really investing. That was just me personally. Okay. So you have to do what's right for you, but I would kind of encourage you to kind of look at it from that lens, from that perspective. Is that really what you want? Do you want $2,500 in Asura? I don't know. Maybe you do. So that's something to think about. And for everybody else out there, that's something to kind of think about when you have all of these different companies and you have ETFs. You're only going to be investing maybe a couple $100 or $1,000 into your individual companies, assuming you want to keep your risk low and not have more than 5% into an individual company. So something to think about. Overall, I love your way of looking at this. I would just kind of ask the question, is that really what you want, right? So hopefully that helps. Hopefully you kind of look at this from a new light, and thanks for sending over your portfolio. All right, the last portfolio is from Mason. Now, this is an older email. I found it in my inbox. It is actually a little bit older. For some reason, I missed this one. I should have reviewed this much sooner, but this is a little bit of an older email. Okay, so bear that in mind. So Mason writes here, hello, new to M1, starting a boring, hopefully non-volatile pile with borrowed money in the hope of using additional leverage through the best in the industry margin in M1. So right off the bat, that scares me. Borrowed money. Now, if you were investing, with borrowed money when interest rates were at 0, then yeah, okay, whatever. But now with interest rates, the borrow rate, even if you have M1 plus, it's still like 7%. So really, really not ideal. And if you don't have M1 plus, it's like almost 8 or 9% to interest rate. So borrowed money, once again, this is an older email. So now it's like, not ideal. You pulled $220,000 of equity out of your primary residence, so 60% loan to value as it sits. So looking to place about 220 grand and something boring and stable that'll allow a benefit over time. Need to beat 2% APR on the refi, so the bar is relatively low. Okay, so if you refinanced your house at 2%, I think, and it's a fixed rate of 2%. Okay, you probably did okay. But if that's a variable rate and it changes, I would not even touch it with a 10-foot pole. When it comes to leverage and investing in the market, it's sketchy, man. I'm really skeptical when it comes to that. So you've attached your M1 Pi is basically a combination of a margin portfolio that I plagiarized from Joseph Hughes on YouTube. Man, there's a lot of stuff in this email. Oh my gosh. Then I added SHD and Nusi because I like them. Only have 5K in there now. Anyhow, my primary concern at this point is jumping into large positions in a bond now with the looming interest rate hikes in the future. Oh, FYI, those hikes actually did come. So this is me from the future, or the past. I don't know. The future in this sense. Seems a little suicidal to do at this point with rates as low as they are. I'm 50 with a typical 15-year time horizon, total liquid assets of around 450K, hoping to hit over 1.3 million by 2030, which would be great. Okay, so Mason, first off, I'm not laughing at you. I'm laughing with you. Just genuinely, I want to make that clear. I think this is really interesting. Okay. So, obviously hindsight, is 2020. Obviously I know things that are very different than when you sent this email when interest rates were lower. But generally, investing on margin is not something you do for the long term. As a dividend strategy, it generally does not work. It's not ideal. The next thing is, plagiarizing, and I love that you acknowledge it and you realize it. And a YouTuber and a YouTuber's portfolio usually is also not a good idea. So a couple of things. You're investing into somebody else's dream. You're investing into somebody else's time horizon. What you want to do is you want to educate yourself on what's right for you and what's right for your goals. You want to take inspiration. You don't want to plagiarize. Okay. They're very, very different. You can get inspiration, but don't plagiarize. Don't just copy blindly, because it's not going to work long term. You're going to second guess yourself. You're going to lose sleep. Maybe something happens. Like, it's just never a good idea. Okay. So you're 50 years old. As I mentioned earlier in the video here, you want to make sure that you're optimizing your account types. So your Roth IRA, your 401k, that's the very first thing that you want to make sure that you're optimizing, is you are taking advantage of tax advantage accounts. It's one of the best things that we have here in the United States when it comes to investing, is these tax sheltered accounts. So really important. And then I guess the last thing here is, you said that you're investing heavy into bonds, but you want your portfolio to more than double in 15 years. The last thing here is go and research, after this video, Google the rule of 72. The rule of 72. Bonds generally don't compound and grow as fast as equities, stocks, companies. So you want to make sure that you understand how bonds compound versus how a company like an Amazon or a Coca-Cola or a PepsiCo, compound. So very important to understand the rule of 72, because it's very unlikely that a bond, it depends. It's unlikely that a bond is going to more than double in 15 years. So let's take a look at your portfolio. So this is, since 2019, you have 5 holdings, 4.7% interest rate, expense ratio of 0.22%, the Joseph Hughes portfolio. So I know of Joseph Hughes. I know he's the bow tie guy. I don't know. I don't really follow his channel as, so I don't know if this is accurate. I don't know if this is up to date. Maybe somebody in the comments can let us know if this is still accurate, somebody that follows his channel. I don't know if this is accurate. Okay. So I'm taking this at face value. Okay. So, and I'm not evaluating Joseph Hughes in this sense. I'm not, reviewing his portfolio. I'm reviewing this for the individual Mason here in terms of, the information that he gave. He's 50 years old. Is this the right approach for him with his goals of reaching, $1.3 million in 15 years? Okay. So I want to make sure that it's clear that I'm not reviewing Joseph Hughes's portfolio here in that context. Okay. So a couple of things. So you want to grow your portfolio. You want it to compound. You almost want it to triple from 450 to 1.3. That's almost a triple. You're not going to get there with bonds. Even with a high yield, this is not going to compound and grow as fast as if you were to just invest in the S&P 500, for example. If you were to invest in this S&P 500, I'd say you'd have a decent shot, a potential shot of reaching that goal. Even though it would be still a bit of a stretch. I don't have a crystal ball. I don't know what the market's going to do. But you got high yield bonds, you got long-term bonds, you got low volatility. I think I've talked about this one here recently. This is a pretty good ETF. SEHT is a good ETF. NUSI, I've talked about NUSI in the past. Man, I was so disappointed with NUSI. Like, I don't want to get too much into it, but I was deeply disappointed in NUSI. I got out of NUSI, shortly after I was researching it. SHD is great. SHD is a really great asset, a great vehicle to help get you to that goal, to that destination that you're looking to get to. I guess, a couple of things. So first off, don't invest on margin. Just don't do it. Just avoid it. Like, just don't do it. Okay. When it comes to these ETFs, they're really high quality ETFs, but they're really not going to get you to your goal. Like, this would be better if you were already at your goal, you're 50. So if you were at 65 and you already had the 1.3 million, if you already had 1.3 million in your account, then it would, in my opinion, it wouldn't be the worst idea to transition out, rebalance out of what you had into something like this. But you don't build your portfolio around this to get you to that goal, to get you to that destination of 1.3 million. Do you understand? In this case, you want to invest into something that's going to have a little bit more risk, more volatility, but you get paid to carry that volatility. Okay. If you don't want volatility, you need to readjust your goal. You need to reassess and say, all right, instead of 1.3 million, maybe I'm going to get 550,000. Okay, something's got to give, right? You can't have your cake and eat it when it comes to this. Okay, so what you could consider is after you understand the rule of 72, you could look at, okay, over the next 15 years, what if I invested into a total US stock market ETF like VTI or a combination of SCHD and DJRO or something like that, and then the portfolio it's growing and growing and compounding over the next 15 years, then I can decide what I do. Do I keep it and keep it compounding, or do I rebalance into these high yielding bonds? Okay, but you're looking at it backwards. This is your end goal. You need to get there first before you can enjoy your end goal in this sense. Okay, so I hope that helps. I hope that makes sense. I hope that there was a little bit of a light bulb that went on there when I was explaining that. And if you have any other questions, leave me a comment and I'll clarify a little bit more if something is unclear. But all in all, thank you so much for sending over your portfolio. Hope it helps. Stay away from margin. Hope the video was helpful. I hope you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.